If you are an immigrant living in the United States, whether you are here on a visa, holding a green card, waiting for citizenship, or supporting family members overseas through money transfers, what we are about to discuss today could affect your finances, your immigration future, and your peace of mind in ways most people do not fully understand. There's a rule in the American financial system that millions of people have heard about but very few actually understand correctly. It is commonly referred to as the $10,000 rule. Some people think it means you are not allowed to deposit more than $10,000 into your bank account. Others think it only applies to rich people, business owners, or people involved in criminal activity. And many immigrants have been given dangerous advice by friends, social media posts, or even informal tax preparers who tell them to just keep deposits under $10,000 to avoid attention. That advice can put you in serious legal trouble. In 2026, with financial enforcement expanding and federal agencies sharing information more aggressively than ever before, misunderstanding this rule is no longer a small mistake. It can lead to frozen accounts, IRS investigations, suspicious activity reports, immigration scrutiny, and in extreme cases, even criminal charges. So stay with me through this entire discussion because today we are going to break down exactly how the $10,000 rule works, what structuring actually means, why immigrants are especially vulnerable to problems in this area, how remittances and foreign accounts are now being watched more closely, and most importantly, what you can do right now to protect yourself and your family. Let us begin with the foundation of this entire system, the Bank Secrecy Act. The Bank Secrecy Act was passed by Congress in 1970 as part of a broader effort to combat money laundering, organized crime, tax evasion, and illegal financial activity. Under this law, banks and financial institutions operating in the United States are required to report certain types of financial activity to the federal government. One of the most important reporting requirements involves cash transactions exceeding $10,000 in a single business day. Whenever a customer deposits more than $10,000 in cash, withdraws more than $10,000 in cash, or exchanges large amounts of currency, the financial institution is required to file what is called a currency transaction report, commonly known as a CTR. This report is submitted to the Financial Crimes Enforcement Network, also known as FinCEN, which operates under the United States Department of the Treasury. A lot of people panic when they hear this because they assume that any report automatically means they are under investigation. That is not necessarily true. Currency transaction reports are filed every single day for completely legal transactions. Businesses deposit cash revenue. Families make large withdrawals for purchases. Immigrants transfer savings between accounts. A CTR alone does not mean you did something wrong. The problem begins when people try to avoid the reporting requirement itself. This is where the concept of structuring becomes critically important. Structuring occurs when someone intentionally breaks up transactions into smaller amounts in order to avoid triggering the $10,000 reporting threshold. And this is the part that shocks many people because they assume staying below $10,000 somehow protects them. In reality, intentionally avoiding the reporting requirement is itself a federal crime under 31 USC Section 5324. Think about how dangerous this misunderstanding can be. Imagine someone deposits $9,500 on Monday, another $9,000 on Tuesday, and then another $8,500 later in the week because they believe keeping deposits below $10,000 will help them stay under the radar. If a bank or federal investigator concludes those deposits were intentionally structured to avoid reporting requirements, that person could face criminal investigation even if every dollar was earned legally. Structuring laws focus on intent, not merely the source of funds. That means even honest, hardworking immigrants who earn money legally and paid taxes can accidentally create serious problems if they follow bad advice about splitting transactions. Banks today use sophisticated monitoring software powered by artificial intelligence and advanced analytics specifically designed to detect patterns associated with structuring. The moment a bank sees repeated deposits just under the reporting threshold, unusual transaction timing, or sudden changes in financial behavior, it can file what is called a Suspicious Activity Report, or SAR, with FinCEN. Unlike currency transaction reports, suspicious activity reports are specifically connected to potential illegal behavior, and customers are generally not informed when a SAR is filed about them. Now let us talk about why this issue matters so deeply for immigrants in 2026. Over the past 2 years, the relationship between financial enforcement and immigration enforcement has become significantly more connected. Executive actions, interagency agreements, and expanded data sharing between federal agencies have created an environment where financial irregularities can potentially affect immigration cases. In 2025, federal authorities increased cooperation between immigration enforcement agencies and financial regulatory bodies, raising concerns among immigrant communities about how financial information might be used in immigration proceedings. While certain court rulings have temporarily limited direct access to specific taxpayer information, the broader enforcement landscape remains highly active and constantly evolving. This means that immigrants today face a level of financial scrutiny that many never expected when they first came to the United States. A bank flagging suspicious activity does not automatically mean immigration consequences will follow, but financial irregularities can become part of broader background reviews, especially during applications for naturalization, green cards, visa renewals, or adjustment of status processes. Inconsistent financial records, unexplained income, or patterns suggesting evasion can create complications that extend far beyond taxes or banking. One area where immigrants are feeling these changes most directly is in the world of remittances, the money millions of people send home to support parents, children, spouses, and relatives overseas. Sending money abroad is a completely normal and lawful activity, and immigrant families contribute billions of dollars annually to support loved ones around the world. But in recent years, federal agencies have placed increased pressure on remittance companies like Western Union, MoneyGram, and other transfer providers to monitor transactions more aggressively. Financial institutions are now expected to scrutinize transaction patterns, verify identities carefully, and report suspicious activity when something appears unusual. In practical terms, this means immigrants who suddenly change how much money they send, how often they send it, or where they send it may attract additional attention from compliance departments. Again, this does not mean remittances are illegal. It means the regulatory environment surrounding cross-border payments has become more intense and more heavily monitored. Beginning in 2026, another major change added even more complexity for immigrant families who regularly send money overseas. A new 1% excise tax on certain cash-based remittances took effect, increasing the cost of sending money abroad through cash-funded transfer methods. This change primarily affects people who walk into remittance offices and pay cash to send funds internationally. Account-based transfers funded directly from bank accounts or electronic payment systems are generally treated differently under the current framework. For many immigrant families already struggling with inflation, housing costs, and supporting relatives abroad, this additional financial burden can feel significant. More importantly, the increased scrutiny around cash-based transfers means that immigrants need to understand exactly how their money transfer activity is being documented and monitored. Financial institutions today are collecting more information, verifying more identities, and maintaining more detailed records than ever before. But there is another layer to this conversation that many immigrants overlook entirely: foreign bank accounts. Millions of immigrants living in the United States still maintain savings accounts, pension accounts, investment accounts, or inherited property overseas. Some people have joint accounts with aging parents. Others kept accounts open in their home country after immigrating. Many do not realize that United States law requires certain foreign accounts to be reported annually through a filing known as the FBAR, or Foreign Bank Account Report. Under the Bank Secrecy Act, United States persons, including green card holders and individuals who meet the substantial presence test for tax residency, must file an FBAR if the combined value of their foreign financial accounts exceeded $10,000 at any point during the calendar year. And this is important. It does not matter whether the account held more than $10,000 at the end of the year. If the combined balance crossed that threshold even for a single day, the reporting requirement may apply. The penalties for failing to file an FBAR can be severe. Non-willful violations can result in substantial civil penalties even when someone genuinely did not know the rule existed. Willful violations carry dramatically higher penalties and can potentially involve criminal exposure in extreme cases. What makes this especially dangerous for immigrants is that many people rely on tax preparers who complete their income tax returns but never mention FBAR obligations, because FBAR filings are submitted separately through FinCEN rather than through the standard IRS tax return system. Some immigrants have lived in the United States for years without realizing they had foreign account reporting responsibilities the entire time. Others mistakenly assume small accounts or family accounts do not count. Unfortunately, misunderstanding the rule does not eliminate the obligation. In today's enforcement environment, gaps between financial disclosures, tax filings, and immigration applications can raise questions that become difficult to explain later. Separate from the FBAR is another reporting requirement called Form 8938 under the Foreign Account Tax Compliance Act, commonly known as FATCA. This form is filed with the IRS alongside a taxpayer's regular tax return and applies at higher account thresholds depending on filing status and residency location. The key point many people miss is that the FBAR and Form 8938 are entirely separate filings with different rules, thresholds, and agencies. Filing one does not automatically satisfy the other. Some immigrants assume their accountant handled everything because Form 8938 appeared on their tax return, only to discover years later that no FBAR was ever filed with FinCEN. By that point, correcting the problem can become far more complicated and expensive. For immigrants pursuing green cards, citizenship, or visa renewals, financial compliance has become increasingly important in overall background screening processes. USCIS does not directly collect FBAR forms, but inconsistencies involving income, foreign accounts, unexplained financial activity, or discrepancies between tax records and immigration filings can become issues during adjudication. Imagine applying for naturalization and suddenly being asked questions about overseas income or accounts that were never properly disclosed. Even if there was no criminal intent, failing to maintain consistent financial records can create stress, delays, and scrutiny during immigration proceedings. Transparency and documentation are now more important than ever before. So what should immigrants actually do to protect themselves in this environment? First, review all foreign financial accounts you currently hold or have signature authority over. Gather records showing maximum balances, institution names, and account numbers for every account connected to you outside the United States. If your combined foreign account balances exceeded $10,000 at any point during the previous calendar year, speak with a qualified tax professional about FBAR filing requirements immediately. Second, review how you send money overseas. If you rely heavily on cash-based remittances, consider discussing safer and more transparent account-based transfer options with your financial institution. Third, stop any pattern of intentionally splitting cash transactions to remain below reporting thresholds. If you have been doing this based on advice from friends or social media, understand that continuing the behavior could expose you to significant legal risk. Fourth, maintain organized financial records. Save bank statements, remittance receipts, wire transfer confirmations, tax filings, and all financial documentation for multiple years. Good records can protect you enormously if questions ever arise. And finally, if you discover past reporting mistakes involving FBAR filings or international accounts, seek professional guidance before an investigation begins. There are compliance procedures available for non-willful violations, but those options become much more limited once authorities initiate audits or investigations. One of the biggest problems in immigrant communities today is fear combined with misinformation. Social media rumors spread quickly, and many people now believe that simply having a foreign account or sending money home can trigger deportation. That is not accurate. Having foreign accounts is legal. Sending remittances is legal. The key issue is compliance, transparency, and accurate reporting. Federal enforcement actions are generally focused on fraud, money laundering, tax evasion, and intentional concealment rather than ordinary lawful financial activity. However, the reality is that financial oversight has become much stricter, and immigrants must understand their responsibilities more clearly than ever before. At the end of the day, this conversation is not about creating panic. It is about empowering immigrants with accurate information during a time when financial rules and immigration enforcement are becoming increasingly interconnected. Millions of immigrants contribute enormously to the American economy while also supporting loved ones abroad. There is nothing wrong with working hard, building savings, or helping your family overseas. But in 2026, staying financially compliant requires greater awareness, better documentation, and more proactive planning than many people realized in the past. The strongest protection you have is not secrecy or fear. It is understanding the rules, keeping accurate records, reporting honestly, and seeking qualified professional guidance when needed. Your financial activity, your immigration future, and your family's stability are too important to leave to guesswork or bad advice from the internet. Stay informed, stay organized, and always verify critical information through official government sources and trusted professionals.